All right. Happy Tuesday, everyone. Rich Swerbinsky with the Mortgage Collaborative here once again with the last week in mortgage today. Our weekly whirlwind through all the latest and greatest in the residential lending industry. Each week, I ask one of our lender members to join me as my co-host, and in the co-pilot seat this week, the Chief Strategy Officer from Southwest Funding, Marc Perez. Marc, great to see you, bud.
Good to see you. Thanks for the invite.
Absolutely. And before we get into it, if you could level set for the audience, if you could tell us a little bit about Southwest Funding, your role, anything else of note about the company.
Absolutely. So Southwest Funding LP is an independent mortgage banker. We're a private mortgage banker and started back in 1993. So the company was founded by one individual, and that's Don Young. Over the years, he started off as a broker. He had a couple of partnerships, eventually acquired his warehouse lines, graduated as an emerging banker, eventually brought on a full delegated underwriting team and staff. I initially got hired back in April of 2015 as director of secondary to start the hedging platform and take the company mandatory. And so we did that. And the company's doing well. We are licensed in 36 states, and we are a 99% retail and a 1% TPO shop. Company's doing well. Year to year, between 2019 and now, numbers look good. And I tell everybody, we really got to scratch out the two COVID years. Just scratch them out and look at what your numbers look like between 2019 and now. And if you look at that makes sense.
It's a great point. And I've heard so many of our really smart lenders lay it out that way. Like, forget the last 2 years. They were great. You were able to make a lot of money, but they were an anomaly brought on by a unique worldwide event. And we're back to reality now. So I know a lot of our members are looking at their year over year numbers, not against 2021, but against 2019. Right, Marc?
That's exactly correct. And, one of the biggest things and biggest hurdles with everybody at the beginning of the year is that everybody was staffed for the COVID years for 2020 and 2021. And so, we saw a lot of companies lay off a bunch of employees because they were staffed for that, and the volume just, ticked down. It's just not the same as it was then. So, it's never an easy conversation. Southwest Funding, for the first time in the history of the company, had to lay off people this year. And never a good topic, but, you need to right size and kind of get back into perspective so you can be profitable.
It's one of the really challenging things about our industry. It's so cyclical. Technology certainly starting to have more and more of an impact, but really very human industry still, more so than I thought it would be 5 years ago from today. And it is challenging. I just remember our members at the winter of 19 and now this year, kind of the same thing. Like, like the type of member that joins TMC, it's stereotyping a little bit. It's the type of company that does not want to lay people off, that typically hasn't in their history. And a lot of our members this year that tried so hard not to do that. But at some point, you have to kind of manage the expense side of your balance sheet with the income. There has to be some corollary.
That's exactly correct. And, that's kind of, we saw a lot of people do. So it's been an interesting year, and it's been an interesting ride, to say the least, in the last couple of years, and kind of where we're at now.
Never a dull moment in the mortgage industry. And it's a little trip down memory lane, but let's go ahead and get into the news of the week, Marc. And let's start with some news that just came out yesterday. Wells Fargo announcing, or media sources announcing, their plans to what they called a major retreat from the mortgage business. This is I don't know if it's the end of an era, but it is the cascading of a pretty significant run for Wells Fargo. A little trip down history lane. Wells, if I remember correctly, I think Wells, they had a subprime arm that they sold like 6 months before the meltdown, if I remember correctly. Got really lucky to unload some of that side of their business before everything really melted down. you fast forward to like 11, 12, the few years after the meltdown, and Wells Fargo had emerged to a dominant market share. I remember at one point, I think it was 33% market share in the US mortgage market, which is incredibly significant. So to hear them say that they could be winding things down, maybe shuttering or greatly diminishing their correspondent lending division, big news for our industry, Mark.
Yeah, that's exactly correct. Wells Fargo, post 2008 crisis, they were on the forefront of lenders. A lot of lenders were backing out of the sector. Wells Fargo was just charging forward. And since that time, over the past decade, they probably brought in, something like $57 billion in fees for mortgage operations. So, if you start looking like within the last year, kind of what's been happening, on the business side, everything from compliance to scandals to, there was something about a gap in approvals between blacks versus whites that wanted to refinance. There's just a lot of turmoil and distress that went in there. I think a lot of executives at Wells Fargo, are really taking into consideration, all of that and how much of the mortgage business they really want to compete in. We don't really know for a fact what they're going to do with their correspondent lending channel. Bloomberg cites, they could potentially shrink it, or they could potentially halt correspondent lending altogether. Other than rumors at this point, nobody really knows what exactly that's going to mean. My best guess, and I have nothing to back this up, is I would just say, I could see them, shrinking down the correspondent lending channel. But who knows? They could just completely get rid of it. That's still out there to be determined. So.
I know it's fashionable to hate on the big banks, and I would guess public opinion polls, most people in America would have a negative opinion of big banks. But great point by you, Mark. Like, Wells Fargo played a critical role post meltdown in helping fill the gap and help to satiate demand from originators during some really critical years for not only the residential lending industry, but the broader economy. We all remember what happened in 07 and 08 and the tailwinds that it kind of cast on our broader economy. And the presidential, I remember the Obama-McCain presidential election, and McCain just couldn't answer the mortgage meltdown questions quickly enough, and really cost him the election. It was huge news at the time. But it's tough for big banks to be in mortgage. We've heard Jamie Dimon at Chase speak just incredibly candidly about this over the year. I'm paraphrasing, this is not a direct quote, but Jamie Dimon basically has been saying since the beginning of time, like, listen, we're only in mortgage because we have to, because our bank has branches all across America and people walk into them looking for home financing. If it wasn't for that, we would not be in mortgage. It's too up and down, it's too regulated, it's too unpredictable. But so we'll see what happens from this, but good news for small to medium-sized mortgage lenders. Every time a big guy gets out of it, we see some of the issues that some of the big public IMBs are now speaks to some of the advantages of the small to medium-sized independent mortgage banker, of which Southwest has been one for many years.
Absolutely, and I think this is going to be, like you said, a big opportunity, especially for non-banks to kind of get out on the forefront. As they back down from the mortgage origination side.
This is the last week in Mortgage Today. I'm Rich Swerbinsky with the Mortgage Collaborative. This week, joined by Chief Strategy Officer Marc Perez. Marc, the rate climate in general, obviously a roller coaster here in 2022. I've seen a little relief as of late. Dipping back down, rates dipping last week back into the high fours, now kind of bouncing in the low fives. But right now, just a lot of uncertainty. I think people are like, I can't remember a time where there's been more uncertainty about where our general economy is heading than we have right now. You got people all over the board because there's a lot of mixed signals. You got a very strong labor market. People are still spending money by the data really irrationally into the face of high inflation and racking up credit card debt, but they're still spending money. Yet inflation is taking a toll in other areas. How do you see just like the broader U.S. economy right now, and maybe how it relates to interest rates that we could see later on this year?
Yeah, so you hit the nail on the head as far as roller coaster. I mean, right now, we've had this ongoing just mixed signals between the market where people are suggesting things are getting a little better. Mary Dolly from the San Francisco Fed this week actually cited that even though the inflation the number came in at 8.5. The reality is we're still very far from the Fed's target rate at 2%. And so we have a lot of work to do. So yes, we are seeing signals as far as employment and things looking a little better. But I think we'd be foolish to just jump to the gun and take that as gospel. We would really need to let that saturate. And the markets are kind of torn. Bond traders right now are, torn up between a 50 basis point hike in September versus a 75 basis point hike in September. And that is, just indicative to some of the confusion and kind of where everything's going. Honestly, I think until we get the new CPI report that's going to come out in, next month, we're probably not going to get a really good signal whether it's going to be a 50 or a 75 basis point hike. But back to the mortgage rates and how that affects it, it's like, obviously our mortgage rates, follow the traction of mortgage-backed securities or MBSs. And so with that, an MBS is essentially a bond. And, that uncertainty and that turmoil, I think, it's in the screens. And so it's kind of been up and down. And, ideally it's going to stabilize here at some moment, but when's it going to stabilize? That's still unknown because there's still a lot of factors out there that are influencing where it's going to land or what's going to happen in the next market. Honestly, in my personal opinion, I don't think we're going to see any type of stabilization. We're going to kind of stay in this similar rate environment at least for the next year, possibly even the next 18 months, if I had to make my best guess.
Good point. And yeah, I mean, your point, everything is fueling up this inflation data right now. Everything is fueling off of investors' expectations of the rate and pace and direction of inflation. You noted that the next big inflation related number, the CPI number that we'll get next month. Still a weird dynamic in the market right now because we've had three pretty positive big economic numbers in a row. We had a really good jobs report for July. We had CPI, the last CPI data from a week or so ago that was tamer than expected. And then got a really good report yesterday on industrial production, manufacturers, people that are producing goods in America, their activity stronger than expected. Again, speaking to a resilient economy and business activity and consumer spending. But like throughout the history of time, like good economic news typically would mean stocks would rally and mortgage rates would drop. Right. Bad economic news, we'd have the flip side of that happen. But now it's really weird. It's like you get good economic news and people are like, oh crap, the Fed's going to raise 75 instead of 50 or 100 instead of 75. And we've had all stock and bond markets selling off on good news. And that's kind of what we've seen this last week with 30-year fixed rates going from the high fours to the low fives, no?
No, that's exactly correct. And kind of to recap what you're saying. So, in past years, we've really seen some observations of some efficient market theory at play where, you can kind of tell, the market could kind of tell and price in what was going to happen with the hikes or kind of where we're going to go. And, we're really not at that point, at any given day, just spreads can just drop or increase because we just get compounded by a bunch of data, whether it's economic, whether it's home builders or inventories, I mean, it's just all getting jam packed, and it's just causing a great deal of heterogeneity in the marketplace.
You mentioned the home builders, Mark. That's where I was going next. Just yesterday, the National Association of Home Builders Housing Market Index, which measures the pulse of the single family new construction market, fell for the 8th consecutive month to a reading of 49 in this home builder housing market index. Again, 8 months in a row of drop. Any reading above 50 is considered still generally positive. So this drops below that logical barrier. Index has fallen considerably from a year ago. Some of the commentary issued by National Association of Home Builder executives in conjunction with the release said, listen, they said, I don't know if we're in a recession in America, but we're in a housing recession right now. And there are major, major headwinds and problems for home builders. And if they're not addressed, it could have really lingering issues. Your thoughts on the release yesterday from NAHB and some of the comments that surrounded it?
Yeah, so with home builders, they're going under a rough patch right now because their building supplies, the prices of that are increasing and going up. When at the same time, we're experiencing an environment with higher mortgage interest rates. And these higher mortgage interest rates compounded with that, it's making it a little bit harder for first-time homebuyers to kind of come and play into the equation. So, yeah, that's it seems to me, and it seems. I think the consensus is that's kind of brewing us up into a perfect storm, and it generally it wouldn't be positive. So to really fix that, I think we really need to see rates go down a little bit, just to kind of help out a little bit with that, so that they don't have that problem. Either that, or you're going to have to see the building prices that they have to go down, and I don't think that's going to happen, at least not anytime soon.
Definitely worth watching all the data and activity in the new construction market. Also got news just earlier today on housing starts. That's essentially the count of like shovels in the ground, new digs, starts of new homes, which was down just over 10% for single family homes month over month. Building permits, which is a more lagging indicator, like shovel not in the ground yet, but we want the shovel in the ground. That was down 4.3% month over month. So the momentum with new home construction still going the wrong way. But on a more positive note, as it relates to housing inventory, Realtor.com came out with their monthly housing market report just a few days ago. And some positive news, reporting year over year total active listings up over 30% from where we were a year ago. So it feels like, and we've been talking about this for a couple of months, but the data keeps trending in the right direction. Feels like we're getting some relief on the inventory side of ththings. Mark, is that what you're seeing in the markets you guys serve?
Yeah, I mean, again, that's one of those small little signs that I think people, it's a good feel-good sign that you want to charge with and say, hey, this is positive, this is good. But if you look at a macro picture and you extend out the horizon and take COVID into play, we're still not as well as we were before the COVID years. So the COVID years still, we've got now people are taking their masks. We're getting back to normal. People are getting back into jobs. People are getting employed. We're seeing the reports. But I think there's still this lagging effect from, being contained within the COVID years that we still need to get out of until it's really positive. So does it look positive? Yes, absolutely. When you look at it at a micro level and you track the horizon, when you expand the horizon and you start looking at what was happening pre-COVID years, I think there's a little bit more work to do.
That's a great point. And yeah, because you're right, we are up 30% total active listings year over year. But if you go back to the August before the pandemic, I think we were down like 11%. So, and it's not like inventory was robust the summer before the pandemic started. We were talking about not enough inventory on the market even before the pandemic.
Yeah, that's exactly correct. And like I said, I think there's just more work that needs to be done. So yes, while it's positive and we can say hooray, celebrate, we're still not where the market needs us to be in terms of our.
We've certainly had to dig deeper for positive news stories on the last week in Mortgage Today this year. So, well said, Mark. Continuing with the positive theme, though, mortgage delinquencies are at the lowest level since the MBA started tracking them in 1979. And having worked for banks and monitor like employment and mortgage delinquency, highly tied, very strong labor market right now. So not surprisingly, a lot of people working, very few unemployed, people paying their mortgage. That's another great thing, right?
Absolutely. I believe a lot of that is predicated by the fact that we just left a very low interest rate environment. Yes, rates have ticked up and kind of got up to us, but there were still deals where people got lower monthly mortgage rates. Another key factor, and I don't think enough people paid attention to this, but I know at least 12 states participated in this program from a government standpoint, is the Homeowners Assistance Fund, HAF, and I know the state of Texas, participated in it. And what it was the government provided financial assistance to people that fell behind on mortgage payments that were related to the COVID pandemic. And this started back in February and kind of the March area. And so it was basically money that they were giving to help people get caught up. Now, interestingly enough, it really wasn't advertised or marketed very well. So there was a big population of people that didn't know about it. But for other people that were looking for it, it was definitely out there and it was definitely utilized. We know that at Southwest Funding, we were fully aware of the program. So that was definitely something that we wanted to share from a marketing standpoint to just the general community at large. If there are people out there that needed financial assistance to get caught back up, and again, that was around February, I want to say, when that got up there. But it's very good news in general, just in general for the economy and for the people to have out there. I think some of the other states, I believe, were like Louisiana, Alabama, Arkansas. I don't remember, Kentucky, Mexico. So.
This is the last week in Mortgage Today. I'm Rich Swerbinsky with the Mortgage Collaborative. This week, joined by Southwest Funding's Chief Strategy Officer, Marc Perez. We've got about 5 minutes left with Marc. Marc, just a reset really of our industry right now. The crazy run up in rates the first 6 months of the year following the last 2 years. And things kind of, a lot of the headwinds seem like they're lessening. Feels like we're in a reset right now for the industry. Some good signs though for the last 4 months of this year. And how's just general activity been for you guys, and anything particular that Southwest is looking at from a strategy standpoint as we get into the back half of 22?
Yeah, so like I mentioned, volume's down. I think everybody's volume's down in the industry. That's safe to say that. Really, it's just, having to evaluate your overhead expenses and, what that looks like, just right sizing everything that you need, just so that you can be a little bit smarter about your business and your bottom line to protect it. Southwest Funding is continuing to proliferate into other states and expand. We have full-time recruiters in-house that talk to people, and they're really, other than maybe 2 or 3 states that we're probably not very interested in, just because of a lot of the legal paperwork and the red tape. We're looking at rolling that out. Purchase volume is keen right now for a lot of people. I think that, actually, I know at Southwest Funding that we've always been a purchase shop. We were never a refi only shop. A lot of guys that are refi only are having a little bit of a tough time right now. So, if you're starting up the business right now, I guess my advice would be, if you want to put all your eggs into the refi basket, it's probably not going to be the best thing to do. Find a methodology to employ the purchase business in whatever that is, whether you're going to be establishing relationships with realtors or whether you're going to be getting purchase leads or whatever your model is. I would definitely have that, and definitely stick to the meat and potatoes of the business. We've seen recently a lot of guys in the non-QM sector kind of go down and start closing shops. If you go to thetruthaboutmortgage.com and you look at the latest closures and mergers, you'll see a complete list of everybody that's gone in there. Some people fairly recently, channels that have gone, specifically in TPO. So yeah, just be cognizant and very resilient when it comes to that as you navigate this business.
Where are you guys at? Work from home? You allowing employees to work from home? You got like a mix? Where are you guys at with that? Now 2.5 years removed from April 2020.
Yeah, so 98% of the corporate employees are back in the office. The 2% are some people that, for whatever reason, whether it's a health reason, that they're working from home. But we're mostly all back, and it was really interesting because during the pandemic, we still had a fairly large population of employees that would come in. Now, we had our social distancing and we realigned the offices accordingly and had masks, but overall we kept it going. And there's two schools of thought, with working from home versus working in the office. And working in the office, I think you get more accountability with people. It's easier to mentor people and kind of see what you're doing. Some people work better when they're behind a desk in an office and they've got a different mindset, whereas you send them home and they tend to lag. The response time is less. But at the same time, depending on the individual could work from home and be more productive. They could get out of bed, roll out, start running their reports, and just keep working. I know the couple of times that I had to work from home during COVID, I would fall out of bed, I would get my reports done, and I just wouldn't know when to stop. And I would keep going. The next thing I'd look up at, my watch, and it was like 9:30, 10 o'clock at night, and I just kept going. Not all employees behave like that, so that's where it's essential to know your employees and know your people, so that you can be better. So, is there really a better way or not? Well, there's two arguments on both sides for that. We've taken the approach that working in the office is something we want to do, and a lot of businesses within DFW, where we work, everything seems to be back to normal. For lack of better words.
Marc, I greatly enjoyed the conversation. Really appreciate you joining me this week. Very insightful, and thanks for joining us.
All right. Thanks, guys.
And to our attendees, thanks as always for spending 30 minutes of your week with us. We're here every Tuesday at 2 p.m. Eastern with the Last Week in Mortgage Today. For our podcast listeners, don't forget our live show on Zoom. You can register at mortgagecollaborative.com. And to our live viewers, the majority of you consume us on podcasts. So subscribe, TMC Connect, wherever you get your podcast. So until next Tuesday, have a great rest of the week, everyone. Thanks again, Marc.
Thank you.
Take care.
Bye.